Okay, now let's continue our discussion on the relationship between futures prices and the expected spot prices. So we basically discussed the first three theories, right? So the first is the expectation hypothesis. The second is the normal backwardation. The second is contango. And remember that the expectation hypothesis basically says that today's futures price should be the same as the expected spot price. And then normal backwardation says that today's future price should be smaller compared with the expected spot price. The rationale behind this result is, well, we assume commodity sellers, they are hedgers. So if the sellers want to induce the other side to take the long position, then they have to give some profit to the long so they have to give some profit to the long position. And we know that in futures, if you're taking a long position, then your profit is given by PT minus F0, right? That is the price of the commodity on this delivery date minus your initial futures price. So in this case, if commodity sellers are hedgers, then PT has to be larger than F0. So that's why we will get normal backwardation. Right? And then we will have the other case, which is called contango. In this case, we assume buyers are hedgers. So by the similar reasoning, right? If buyers are hedgers, then they will want to induce the other side to take the short position. And we understand that for the short position, its profit is given by F0 minus PT, right? So if these short positions, they will have the positive profit, then this has to be larger than 0, which means F0 has to be larger than PT. And in terms of this picture, right, we know that under contango, if we look at a futures time to maturity, right, we will see that in the beginning, the futures price would be lower, right, if there is backwardation. And as this futures approach closer to this delivery date, then its price will be higher, right? And under contango, we will get the opposite case. That is, initially, the price will be high. And then, as this futures approach closer to this delivery date, its price will be lower, right? So basically, this means that if there is normal backwardation, then futures, which is further away from maturity, will have a lower price, right? Of course, this also means that if there is normal backwardation, then futures, which is closer to its delivery date, will have a higher price, right? Now, we could also talk about contango, right? So if there is contango, then it means that if a futures is further away from its maturity date, then its futures price will be higher. And then if a futures is closer to its delivery date, then its futures price will be lower, right? So now let's look at this following example here. This example is actually quite interesting, and it's also very useful because even as a retail investor, if you invest in some financial product which holds futures, then you actually need to understand this backwardation and contango. Okay, so let's say we are looking at VIX futures. So VIX futures is just this futures on VIX index. What is VIX index? Well, in the last chapter, when we talked about this Black-Scholes model, we know that VIX index is essentially the implied volatility calculated from SP 500 futures, right? Anyway, just to consider VIX futures as a futures which is built on VIX index, which is essentially a volatility index. Okay, now let's see what this problem is about. So identify when the VIX futures is in backwardation and contango. So now let's look at this picture here. So first, you can see that the title says this is about VIX futures term structure. Well, I have not talked about term structure, but basically, in this case, term structure is about volatility and time to maturity. Right? The future month essentially refers to its maturity month. Right? For example, this guy has a maturity month of October. This guy has a maturity month of September. Right? So again, term structure here means the relationship between volatility and maturity month. Okay, now let's look at this curve, right? So this blue curve basically tells you how volatility is related to maturity months. Right? Obviously, we have different futures here. This is important because previously, if you look at this picture, it's about a single futures, right? So this picture here basically says that if you look at a single futures, then this single futures in the beginning would have a lower price if there is normal backwardation, and as time goes, as this single futures gets closer to its delivery date, then its price will be higher and higher, right? So this is just a picture about one single futures. Now we are talking about, where's this? Oh yeah, this one. Now we are talking about a future with, now we are talking about a picture with multiple futures, right? Okay, great. Now let's finally answer this question here. When this futures is in backwardation, okay, now let's just pick two futures. So let's pick this guy. So this is the September future. This guy. It's the October future, right? What you can see here is the futures with September maturity has a higher volatility compared with the futures with October maturity, right? What does this tell you? Well, this basically says that a futures which is further to its maturity, right, has a lower volatility, right? Again, let me repeat because this could be confusing. What you can see here is we have the October futures, and this October futures has a lower volatility compared with this September futures. So this implies that a futures with further time to maturity has lower volatility. So this is exactly the definition of backwardation. Right? So here we have backwardation. Again, let me go back to this picture here. This is backwardation because it means that a futures here has lower volatility compared with a futures here. And you can see that on point A, this futures is further away from its maturity, right? And B has a shorter time to its maturity. And now this example is essentially talking about the same thing here. Oops, where's the right? So you can see that October future, which is further away from its maturity, and it has lower volatility. So this is backwardation. And if you look at this whole curve, what you can see here is, roughly speaking, right, from September to December, we have backwardation. And then you can guess that from December to the next year's April, we have Contango. So why do we have Contango here? Well, look at this, right? Again, we just pick two futures, right? So here you can see that March futures has a higher volatility compared with the February futures. This means that, again, this means a futures which is further away from its maturity has higher volatility. And this is exactly what Contango is talking about, right? Again, if you compare this and this, you can see that A, right? A is further away from maturity and it has higher volatility. Okay, good. Now let's look at the second question. Second question says, assume you're long in these futures. As you roll into longer term contracts, will you prefer backwardation or contango? Right. So first let me explain. Because we have this word roll into longer term contracts here. So what does this mean? Well, it means that, let's say you're a investor, right? You're taking long position in VIX futures. Let's say you want to invest for 10 years. But you can see that you cannot hold a single one VIX futures for 10 years because maybe the longest maturity for VIX futures is 2 years. So over this 10 years of time, you have to buy 5 different VIX futures, right? So this basically means when the first VIX futures expire, you have to buy the second. So here we say you roll into this second VIX futures. For example, let's say today is September 31, right? And you would know that on this day, this future, right? This September future will expire, right? So what you have to do is you have to roll into this October futures. So what you will do is you will sell this September futures and you will buy October futures. Now you will be able to answer this question here. You can see that if you have to sell September futures and buy October futures, you will be happy if you're in backwardation because it means that you can sell high and buy low, right? Because as you roll into October futures, you will sell high here and you will buy low here, right? So it basically means that if you take a long position, then if you're taking a long position in futures, if there is backwardation, then you will get this additional benefit because you're selling high and buying low. And you could also see that if you're taking a long position, if there is contango, then it's bad for you because you can see this. Let's say now it's March So you have to sell this March futures and you have to roll into this April futures. What you can see here is now you're actually sell low and buy high, right? So this obviously is a bad idea because sell low, buying high always mean you have to lose some money, right? So this is somewhat a quite obvious result. The reason is because think about this. When you're having this normal backwardation, what it means is this expected spot price larger than this initial futures price. So this has to be larger than 0, right? And then in this case, it basically means that if you buy at F0 and if you sell at this PT, you will definitely get a positive profit, right? So it's very understandable if you take a long position in futures, then you will benefit from backwardation because you can sell high and buy low. So on the opposite, right? You can imagine that if you take a short position in futures, then you will benefit from Contango because in this case, you can see that, let's say, if you're taking a short positions, right? Now, let's say now it is March and you will have to roll into this April contract. So you will sell here and you will buy here. And Contango basically means that you will buy low and sell high if you're taking a short position, right? I also want to comment that here I am using this VIX futures. You don't really need this VIX futures here. This result will hold no matter what kind of futures you're considering, right? So this VIX is not really important here. And the second comment is this example could potentially be confusing because we're talking about backwardation and Contango in two types of pictures, right? Because this picture is different from this picture. So I would recommend you to maybe spend some time to think about this because in the future, if one day you will invest in more complicated financial products which invest in futures, this backwardation and Contango is actually very important. Okay, now let's talk about the third theory. Sorry, let's talk about the fourth theory. It's this modern portfolio theory. The idea is actually pretty simple. So basically, if there is positive systematic risk in commodity prices, then futures prices must be lower compared with expected spot price. So basically, you can see that under modern portfolio theory, we will have F0 smaller than expected spot price. So here you can see that modern portfolio theory and backwardation will give you the same result, or modern portfolio theory and this normal backwardation, they have the same predictions on how futures price and expected spot prices are related. So let's see how can you get this result. All right, so our purpose is we want to understand how can we get this result using modern portfolio theory. So let's first think about this discounted cash flow theory, right? So let's say we have a share of equity, right? So its today's price is P0. Now, how do you get this P0? Well, one way to get this P0 is we could discount its future price by some discount factor, right? So let's say this K is the cost of equity, right? So this is basically simple discount theory. That is, okay, to make this even more clear. So let's say this is time t, and there would be so the share price on time t would be PT, and you're asking what is the today's share price, right? P0. What you can do is obviously discount this future share price by this appropriate discount factor. Here the discount factor is the cost of equity, right? Now, we also have this spot futures parity theorem. We learned about this in the previous lecture. So and future price and spot price are related, right? This is the this is spot futures parity theorem. Let's assume for simplicity there is no dividend. Right, so let me remove this. So basically you can see that by this parity theorem, we could find out P0 equals F0 divided by 1 plus RFT. Now very nicely you can see that we have 2 P0, right? So we could get the following result, that is F0 divided by 1 plus RFT equals E PT divided by 1 plus KT. And then we further manipulate this equality, we could find out F0 equals EPT times 1 plus RF divided by 1 plus KT, right? What you can see here? Well, we know that by CAPM, right? By the capital asset pricing model, we know that K has to be larger than RF, right? Well, if you cannot remember CAPM, we know that by capital asset pricing model, K, that is the cost of equity, equals RF plus beta times the expected market risk premium minus risk-free rate. So this has to be larger than RF. So if K is larger than the risk-free rate, then it means 1 plus risk-free rate divided by 1 plus the cost of equity has to be larger, has to be smaller than 1. Right? Okay. So you can see that if this guy is smaller than 1, then it implies the left-hand side has to be smaller than EPT, right? So basically you can see that F0 is smaller than expected spot price, right? So this is actually, this result is obtained by actually 2 theorems, right? So the first is the parity theorem. The second theorem is this CAPM theorem, right? And you can see why this is called modern portfolio theory. The reason is because CAPM is obtained from the modern portfolio theory. So you can see that under this modern portfolio theory, we essentially get the same result as we have got from the assumption of backwardation, right? That is, the futures price is smaller than expected spot price. Okay. So how do you understand this? Well, basically, you can imagine that if you're taking a long side of this contract, and if this underlying asset has this systematic risk, then because you're taking a long side, so you should get compensation for bearing this systematic risk. So obviously, you have to get some profit as a compensation, right? So futures price should be smaller than expected spot price. And then investors there who are in the short position, they will be willing to suffer this loss to lower this portfolio risk, right? Because they're taking a short position. And if this underlying asset has a positive beta, then when you're taking a short position, then this asset will have a negative beta. When you have a negative beta, then you will be happy to accept a loss. Okay, now let's talk about more practical examples. So we will talk about 3 different kinds of futures markets. To be more specific, we will talk about foreign exchange futures and this equity index futures. And then we will talk about futures on fixed income and interest rates. So it's pretty easy to see that when you're talking about foreign exchange futures, then you're essentially thinking about future contracts based on foreign exchange rates, right? And then this equity index futures will basically based on the value of different indexes. Okay, now so why do we want to talk about foreign exchange futures? A very important usage of foreign exchange futures is about hedging against the risk of exchange rate. It's actually very easy to understand why do you need to hedge against this exchange rate risk if you live in Canada, right? So think about this. If you live in Canada, a lot of time you will invest in some US asset, right? For example, a lot of Winnipeggers have houses in the US. That is definitely a US asset, right? Denominated in US dollars. And because the Canadian stock market is much smaller compared with the US market. So generally, if you open an investment account, you will have access to the US equity market. So in this case, if you convert Canadian dollars into US dollars, and then if you use US dollars to buy some US shares, then you will be exposed to this exchange rate risk. The reason is because after converting Canadian dollars into US dollars, then you will have this US dollar denominated asset. Let's say in the future, someday in the future, you will want to convert this US denominated asset, either a house or some shares, back into Canadian dollars, because ultimately you live in Canada. In that case, you really don't know in the future what would be the possible exchange rate, right? So you can see that the possible changes in the exchange rate could either hurt you or benefit you, right? So you can see that this is a type of risk. And this risk can be hedged through currency futures. Okay, now let's see this. Let's read this table, which is a table about different exchange futures. So let's just look at exchange futures on Canadian dollars and British pound. So you can see here, the quote here is quoted in terms of dollars per Canadian dollars, right? So you can see that this settlement price basically means for 1 Canadian dollars, you need to spend 0.7676 US dollars to buy it, right? Of course, this one is basically contract size, right? It says that for one contract, right, you have to purchase 100,000 Canadian dollars. And then for this British pound, this settlement price basically says that you have to spend 1.3273 US dollars to buy 1 British pound. And then you also have this contract size here. So the contract size is 62,500 pounds. Okay. Now let's talk about the spot futures theorem in foreign exchange futures. Interestingly, the spot futures parity theorem will have a different name in this foreign exchange futures. Right? It's called interest rate parity theorem. Well, why do you have this name? Well, it's because you can see that here you have interest rates. However, you can see that this is still a spot futures parity theorem. The reason is because this E0 here is the spot exchange rate, right? And this F0 is the futures price. So it's again about spot and futures. But then spot and futures, they are related using interest rates. So RUS is the US interest rate, and RUK is the interest rate in the UK, right? So that's why this is also called interest rate parity theorem. Now remember that E0 basically means you need E0 dollars to purchase 1 pound, right? That's how you define exchange rate. F0 means you need F0 dollars, right, in the future at time t to purchase 1 pound. Now, how do you get this parity theorem? Let me show you. Let's say you have 1 pound, right? So you have 1 pound. Now you actually have 2 ways to invest this 1 pound. First, you can invest in the UK, right? So you can see that at time t, you will have 1 times 1 plus the rate in the UK, right? This is your future value at time t. Hey, but you have a second way to invest. You can convert 1 pound. So you will convert 1 pound into US dollar, right? And then you will invest in the US, and then you will convert it back to pound, right? So if you're using this second way of trading, how much you can get? Well, first you will convert 1 pound to the US dollars. So you will get E0 US dollars, right? And then you will invest in the US for T periods. So you will get this amount after t periods. However, this amount is denominated in the US dollar. Now you will want to convert this back to UK dollar. No, not UK dollar. So you will want to convert this amount into the UK pound, right? So in this case, well, this is in the future. So you will use this amount and divide this amount by F0. So this is the amount of pounds you can get at time t, right? Obviously, in a world of no arbitrage, these two methods, these two investments, should give you the same result. So this has to be the same as 1 plus R UK T. And then you can see that if you manipulate this, you can manipulate this into F0 equals E0 times 1 plus RF divided by 1 R UK T, right? So this is the interest rate parity theorem we just talked about. Okay. Now we just discussed, to get this interest rate parity theorem, we need this basic assumption of no arbitrage. And you can imagine that if this interest rate parity theorem is violated, then there would be some opportunity for arbitrage. And specifically, this is called covered interest arbitrage. Why this is called interest arbitrage? Well, the idea is, if this parity theorem is violated, then it basically means that a interest rate in one country is potentially too high, and relatively interest rate in the other country is potentially too low. So this is called interest arbitrage. Now, why this is called covered? Well, because when you're doing this interest arbitrage, you could suffer from exchange rate movements. So you will use a futures position to cover, to hedge against this interest rate. You will use futures position to hedge against this exchange rate movement. So that's why this is called covered. I know this looks, again, somewhat ambiguous. So let's look at this example. And it's actually a very simple example. So let's say in the US, the interest rate is 4%. In the UK, it's 5%. And today's, right, the spot exchange rate is $2 per pound. Again, this basically means you need to use $2 to buy 1 pound. Or you could say 1 pound could be converted into 2 pounds. 1 pound could be converted into $2. And let's say the investment horizon is 1 year. Or that's not accurate. Let's say the delivery date is in 1 year, or the span of life for this futures is 1 year. So what is F0? Well, this is pretty simple, right? So we know that F0 equals E0 times 1 plus interest rate in the US and divided by 1 plus interest rate in the UK, right? And then you would plug in numbers. 2 times 1 plus 4% divided by 1 plus 5%. This gives you 1.981. Now let's look at this covered interest arbitrage. So let's assume the interest rate parity theorem were violated. Right? For example, suppose the futures price is actually 1.97 instead of 1.981. So basically you can see that if the futures price is 1.97, we will get this result. That is that is 1 plus 4% divided by 1 plus 5% times 2 larger than 1.97. Now what does this tell you? Well, it sort of says that this interest rate is high, right? And this rate is low. That's why you get this inequality sign here, right? At least relative to this 1.97, this 4% is too high. Now, how do you do this arbitrage? Well, it basically means that if the US interest rate is high, then you should invest in the US, right? And if you want to do an arbitrage, then you should borrow money from the UK, right? So you can see that the idea is pretty simple. It basically means that US has a high interest rate and UK has a low interest rate. So what you will do here is you will borrow from the UK and use the borrowed money to invest in the US. Right? And then if you do this, you have to think about the potential exchange rate movement. So what you will do is you will want to hedge against this this potential exchange rate movement. And now you could see that you're investing in this US dollars. And what you want to do is you will want to take a long position in this futures contract. So let's see, if you do this, what is your profit? So as I said, you will borrow from UK. So let's assume you will borrow 1 UK pound. I mean, this number 1 is not important. You could use any number. So let's say you would borrow 1 UK pound, right? And you will convert this UK pound into $2. And then you will invest this $2 in the US, right? And then you will enter a contract. That is, you will take a long position in this futures contract. And we know that the futures price is 1.97. That is this number. And to be more specific, you will want to purchase this amount, 1.05 pound. Why do you want to purchase 1.05 pound? Well, the reason is because you have borrowed 1 pound from the UK. And at the end of the year, you have to repay 1.05 pound, right? So this sort of says that you have a short position in UK pound. And we know that if you want to hedge against a short position, you should take a long position in the futures contract, right? I mean, the general result on this hedging is if you have a long position in this commodity and you're a seller, then you should take a short position in the futures. And if you're a buyer, or if you have a short position in this commodity and you will buy this commodity in the future, then you should take a long position in the futures contract. Now let's see what is your cash flow. First, obviously, your today's cash flow would be 0 because you get this positive $2 from this borrowed 1 UK pound and then convert it to the US dollars. And then you will use this $2 to buy some US bond. So you will have this cash outflow of $2. And then to enter a futures contract, there is no cost. So today's total cash flow would be just 0. Now let's see what is your cash flow at the end of the year, right? So we know that you need to pay back this $1. Sorry, you have to pay back this £1 borrowed from London, and it's interest, right? And we have 5% interest. So you can see that at the end of the year, you have to pay back 1.05, and this is your cash outflow, and this is denominated in pound. And if you denominate this in dollar, then you have to use the exchange rate in 1 year, E1, times 1.05 pound. Now, the second row, right? So here it basically means that you have invested $2 in the US, and US has an interest rate of 4%. So at the end of the year, you will get 2 times 1 plus 4%. And now the last one, right? Well, what is E1? Well, E1 is just the futures price or the exchange rate at the end of the year. So in this case, you can see that if you have a long position in this futures contract, for one contract, your profit would be given by E1 minus the initial futures 1.97 price, right? Because this 1.97 is essentially F0, right? So this E1 is essentially PT, and we know that as a investor in long position, your profit would be given by the asset price on the maturity date minus your initial price. Of course, this is a profit for one contract, and you have 1.05 contract. So your total profit would be given by this, right? Okay, now having explained different components, you can see that this and this will offset with each other. So your final profit would be this number minus 1.05 times 1.97, which is 0.011, right? So that is without any cash outflow in the beginning, and in the end, you will get a positive cash flow at the end of the year. So this is an arbitrage profit, right? Okay. Now let's talk about a practical matter, right? That is direct versus indirect quote. So in the foreign exchange market, exchange rate can have direct quote or indirect quote. So direct quote means the exchange rate is expressed as dollars per unit of foreign currency, right? Say, so if we, oops, where is this? So if you look at this quote here, if you look at this quote, it is a direct quote, because here let's say you're a U.S. person, so Canadian dollar is a foreign currency, right? So here 0.7676 means for 1 Canadian dollars you have to pay 0.7676 US dollars. So this is a direct quote because it is because the exchange rate is expressed as dollars per unit of foreign currency. Now, if you have direct quote, then you will have indirect quote. indirect quote is foreign currency per dollar, right? So let's say if the direct quote says 0.8 US dollar per Canadian dollar, the indirect quote would be 1.25 Canadian dollar per US dollar, right? And when you're having this indirect exchange rate quote, then the interest rate parity theorem will have a different form. To be more specific, you can see that in the case of direct quote, right? Interest rate parity theorem looks like this, right? And if you have a indirect quote, interest rate parity theorem will look like this. Now, what's the difference? Okay, let me copy it here. So, with direct quote, the interest rate parity theorem is F0 1 plus R UK divided by 1 plus R US times E. Oh, sorry. With direct quote, we have F0 equals 1 plus R US 1 plus R UK times E0, right? And then you can see that with indirect quote, you will have the inverse of this guy here. Right? You will have 1 plus R UK divided by 1 plus R US. Right? So basically, when you're using this interest rate parity theorem, then you have to be careful what kind of numbers you're using, right? So if it's this direct quote, then you will use this. If it's a indirect quote, you should use this. But in our exam, we will always use direct quote. Right? So let's remove this confusing component. And I am talking about this. It's just really because in the future, right? Potentially, you could see this indirect quote. In that case, you should know the correct form of this interest rate parity theorem. Okay, as we have discussed, a very important reason we want to talk about foreign exchange futures is because we want to use these futures to hedge against the foreign exchange risk. Right? So let's say this example here. Let's say we have a US firm, and this US firm does its business in the UK. And you can imagine that because the firm sells its product in the UK, so this firm will suffer a loss if UK pound depreciates, right? So in this case, you can see that if UK pound becomes cheaper, then it means that the dollar value of the pound denominated revenue will decrease. So it basically means let me give you a very simple numerical example. So let's say this US firm, right, has a revenue of 1 million pound. Right? So let's think about two exchange rate. So let's say for the first exchange rate, it is $2 per pound. And for the second case, it's $1.2. It's $1.2 per pound. Now you can see that in this case, it's depreciation. It is depreciation because now pound becomes cheaper, right? So in this case, you can see that, let's say you wanted to, this is a US firm. So in the end, the firm needs to convert its pound denominated revenue into dollar values. So you can see that the dollar value in the first case is 1 times 2, right? So it's 2 million US dollars. And then in the second case, the dollar value is just $1.2 million. So you can see that that's why we have this explanation here, right? A second reason, which is more tied to economics, is the US firm can become less competitive if it tries to increase its price in the UK. So the idea here is like this. Let's say you're the US firm and you see that the UK pound depreciates from $2 to $1.2, and you understand your dollar value of your revenue will suffer. So now you could say, okay, I will just increase my selling price in the UK. So I will make my products more expensive. In this case, the increase in the pound denominated revenue can at least partially offset my suffering in this exchange rate, right? However, you can see that if you increase your product price, you will become less competitive, right? So you can see that that's why we have this second reasoning. That is, you could become less competitive if you want to increase your price. So the gist here is, if you're a firm selling in a foreign market, then the foreign country's currency depreciates, then you will suffer, right? It's a bad thing for you. Now, how this firm can hedge against this risk? Well, of course, use futures. At this stage, you should know how you can hedge. Well, again, let's look at this U.S. firm. It has pound denominated revenue. It basically means this firm has a long position in the UK pound, right? So if you want to hedge a long position, what can you do? Well, you should take a short position in the futures, right? Okay, now let's see exactly how this works. So let's say from some past data, this US firm understands that if pound declines by $0.1, then this firm will suffer a loss of $200,000, right? Now you can see that we have a little picture here tells you how can you get this result. So basically what this firm can do is this firm can try to look at its past history, right? Then let's say the firm could find, okay, if the exchange rate is this, my revenue is about 2.1, so I put a dot here. If the exchange rate is, let's say, 1.2, I would have a even lower revenue, let's say 1.8. So you will again get a point here. That is, you can find out the relationship between your revenue and exchange rate during past years. And by this data, you can estimate how revenue will change with respect to the exchange rate change, right? So you can see that in this case, by using linear regression, you can roughly find out the slope here is $2 million. So it basically means if exchange rate decreases by 1, then you will suffer $2 million. This obviously means if exchange rate decreases by 0.1, then you will suffer or you will have a loss of $200,000, right? Now, the question is how this firm can hedge against this risk using futures. Obviously, as I said, hey, you should sell or you should take a short position in this this foreign currency futures. So the firm should sell pounds for future delivery to avoid this exposure. Or you could say this firm should take a short position in this pound futures. Again, whenever you're talking about hedging, you have to think about hedge ratio, right? Hedge ratio is always calculated by comparing the value change in two positions. So here you have two positions if you want to hedge. You have a long position in this UK pounds, and you have a short position in this UK futures, right? So you will want to understand how the value changes in these two positions can be compared, right? And okay, let's see how this hedge ratio can be calculated. What you can see here is you have basically two positions, right? You have a position in this UK pounds and you have a short position in this pound futures. And you can see that if there is a $0.1 change in this exchange rate, then you will lose $20,000, right? And then if there is a $0.1 change in this exchange rate, then for your short futures position, you will earn $0.1, right? So now you will have an idea of this hedge ratio. So basically you can see that for the same change in the exchange rate, you will lose $200,000 in your long position in UK pounds. But then you will be able to earn $0.1 profit for your short position in this UK futures. So basically you can see that to hedge against this drop in your revenue, you need 2 million pounds, right? So it's essentially $200,000, this number, right? This number divided by 0.1, right? Obviously, you can verify that you will be hedged, right? Because you can see that, let's say if there is a drop in this exchange rate and the drop is 0.1, then in your long UK pound position, you will suffer from this. And then in your short futures position, hey, you will be able to profit. Okay? This is your profit. And obviously, the gain will completely offset the loss. So you're hedged, right? And in terms of how to implement this, you can see that for each pound futures contract, you have to deliver 62,500 pounds. So we basically could get this number from the table here. Right? So the contract size is 62,500. So for per contract, the size is 62,500 pounds. This means if you want to enter your short position, you will have to sell the total amount of pounds divided by the contract size. Right? So you should sell 32 contracts, right? Okay, now let's talk about contracts on equity indexes. Our major focus here would be this contract on S&P 500. Obviously, you can see that in actual trading, you can have a lot of futures contracts on different equity indexes. For example, you have Dow Jones, right? You have Russell 2000. You have NASDAQ 100. These are all US indexes. And you have Nikkei 225. This is for Japan. And you have FTSE 100. This is for UK. You have DAX. This is for Germany. This is CAC 40. This is for France. And you have Hansen. Then this is for Hong Kong. Right? As I said, we would only talk about this futures contract on S&P 500. And we won't talk about how to trade this. And, well, actually our main focus on this S&P 500 futures contract is this guy here. This is called contract multiplier. So it basically means contract size equals 50 times the index level, right? Basically, it's something like this. Let's say S&P 500, its current level is 3,000. Then it means that if we have a multiplier of 50, then the contract size is its current index level 3,000 times 50 multiplier, which is 15000, right? So this is the contract size per one contract. We have a size of $150,000. Okay. Let me see. Well, this is weird time. I have like 4 minutes left. Okay. So basically for this futures, so basically for these equity index futures contracts, we will talk about two topics. The first is about creating synthetic positions. This is interesting. It basically says that instead of investing actual indexes, you could replicate your investment using futures. And second, we will again talk about hedge. We will more specifically talk about how could you hedging market risk, right? And then we will also talk about how could you do a market neutral equity selection using this futures contracts. So obviously I'm running out of time, so I will just end here.